Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. After having outperformed significantly during 2021 and the first 9 months of 2022, Indian equities underperformed their global peers by circa 20% since the fourth quarter of last year. This was due to some global and some domestic reasons. On the global front, banking sector stresses weighed on Indian markets too, where financial sector makes up the largest share of the equity benchmark. Further, domestic concerns including weakness in consumption of urban and middle income segments, slowing activity in the rural sector, and issues surrounding Adani Group also impacted negatively. This made India the tiger that did not roar while broader equity markets growled out of their bear market territories over the past 8 months. On this podcast, we discuss why we think this is likely to change now and why the recent market underperformance provides an opportunity for long-term investors to position back into Indian equities. At the macro level, the services sector PMI hit a 13-year high in April. Strong services sector export growth and resilient remittances provide a cushion for the current account deficit. Foreign exchange reserves reached a 12-month high in May. Despite the slowdown in industry credit, the manufacturing sector remains strong, with the PMIs for the sector remaining firmly above the 50 mark at 57.2 in April. Better than expected rainfall and elevated water storage in reservoirs bodes well for agriculture and rural sector broadly. Admittedly, there are concerns that an El Nino will result in deficient rains in the second half of the season. Mobile phone exports more than doubled to $10 billion in the fiscal year 2023, reflecting India's ambitions to be a high-skilled export hub. Falling inflation should allow the Reserve Bank of India to go on a pause after having hiked interest rates by circa 250 basis points over the past 12 months. The impact of monetary policy tightening is evident in consumer discretionary spending like restaurants and housing, and the tighter monetary policy also has impacted the urban disposable incomes meaningfully. A pause in rate hikes now and an eventual rate cut early next year should reverse some of those weaknesses. Now, taking a structural view, India remains a bright spot on the global stage. International Monetary Fund (IMF) expects India's GDP to grow at a consistent rate of 6% over the next 5 years. This compares with IMF expectations for global growth of just 3%. The rise of high-skilled tech-focused export sector, a strong ecosystem of startups, the demographic advantage, healthy macro, and the apt pace of structural reforms could all help India achieve the elevated levels of growth over the next decade. Now, assessing the equity market outlook, after having declined since 2016, Indian corporate profitability trends were reset during the pandemic. The outlook for corporate profit margins and the overall profitability now look much brighter. IBES consensus expects MSCI India earnings to grow circa 22% over the next 12 months compared to a 5% growth for global equities over the same time frame. After the fall in valuations over the recent months, value started to emerge in the Indian equity market. For instance, MSCI India Index is trading at 20 times 12-month forward EPS, while MSCI All Country World Index is on circa 16 times. This implies price earnings to growth ratios of 0.9 and 3.1 for India and global equities respectively, making India a much better value proposition. This should allow the foreign institutional investment flows, which have been weak to negative over the recent months, to return to Indian market. It's always worth remembering that Indian equity markets tend to reward long-term investors quite handsomely. For the context, MSCI India Index returned 11% on an annualized total return basis since the turn of this millennium, while MSCI All Country World Index returned 6% over the same time frame. Now, key risk to our bullish outlook for Indian equities is a US recession. Even in such a scenario, Indian market acts as defensive by falling lesser and recovering faster. In short, we think the recent underperformance provides an opportunity for long-term investors to position back into Indian equities. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and another episode with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.